Climate risk is business risk. From supply chains to bottom lines, extreme weather, resource scarcity, and policy shifts are reshaping the way companies operate, posing both threats and opportunities. This episode of the Columbia Knowledge Series explores how investors, businesses, and regulators must negotiate with climate risk.
Certainly in the West, but especially in India, because it's a very agriculture-heavy economy. It's an area where we constantly get cyclones, floods, typhoons. So there's physical risk. It's also an area where we have, unfortunately, very bad AQIs, meaning air quality in some of the large cities in the country. So for us, I think it's a huge point. How do you decarbonize and how do you grow at the same time? This is the fundamental question, which is not easy to answer. But if you're an individual company, it's probably going to start hurting your bottom line in various ways. For example, if you're a company that makes soda, it's going to raise the price of sugar, or beet. Because some of the impact of climate risk, I think, is showing up in food inflation, not often appreciated, perhaps. Right? That's one obvious place. So if you're a bank and if you're giving out loans to people who are buying houses, and the houses are, these are like very large loans, and they also are long loans, 15 years, 30 years, 40 years. So maybe in the very short run, climate risk is not a problem, but in the long run, it is almost certainly a problem, certainly a game changer. You have to change supply chains, you have to, customer tastes will have to evolve. Mitigation is very expensive. Transition risks in terms of, say, moving to EV and so on bring their own challenges. How do you source nickel, how do you source cobalt, and so on. So if you're thinking long term, and maybe that's the role of the regulator, sometimes companies do get a bit worried about the next quarter and the next year and so on. But maybe, despite the fact that the reporting frameworks, etc., are not fantastic, it's a way for the board to think about climate afresh, think about a long-term perspective, think about how it affects costs, how it affects revenues. Maybe these are opportunities as well. It need not only be a defensive conversation. So maybe a charitable way to think about the check-the-box regulation is to push people to maybe open a blind spot in the boardroom, and instead of talking about the usual problems, which are important, cyber being a new one, maybe you add one more thing. What is our climate strategy?
Many of us want to be socially responsible investors. We are watching and tracking ESG funds. But what is the gold standard to know if ESG funds or other socially responsible funds are really true to their principles?
Typically, if you restrict your investment opportunity set in any way, elementary finance theory tells you that your returns will either go down or your risk will go up. So if you're restricting your set in some way, you are hopefully doing it in a conscious manner. So in this context, what are you trying to do? You're probably trading off values for value. Maybe you do not want to support a tobacco company, which, despite everything, at the end of the day, sadly, ends up giving cancer to people. So, but then you're probably giving up some return. Tobacco stocks are typically, have high yields, they give you good dividends. You could say the same for oil and gas, you could say the same for maybe, guns and weapons. So there is no gold standard, is the answer. You can try various things, you can look at ratings, but rating agencies have their own problems, the ratings don't converge. I would say research is the only answer. It's almost a bit like pornography. You know it when you see it, but it's very hard to define. So putting and lots of regulators have tried. The Europeans have this SFDR, Article 8, Article 9 kind of funds. So what can you do? The easiest thing you can do, I think, if you're really interested in this area, you can eliminate, look for a fund that doesn't invest in tobacco, perhaps doesn't invest in oil and gas, but again, it's complicated. Some of the best green patterns these days are with oil and gas companies. Defense is an interesting area. Is defense good ESG or bad ESG? Depending again on your political views, pre-Ukraine, maybe defense was bad ESG, post-Ukraine, maybe it's not. How do you deal with the Israel-Palestine issue with respect to, if you're Boeing and if you're supplying, products that are probably used in conflict? It's incredibly hard to come up with a gold standard. So do your own due diligence, use some of the secondary data perhaps as a starting point, but not as a definitive point.
Can a law against greenwashing by companies improve our trust levels in corporate reporting practices and ESG disclosures? Investors everywhere want to know which companies or funds are truly complying in letter and spirit.
Labeling is an eternal problem. Take eggs. In the US, we can get like 6 types of eggs: natural eggs, omega-6, omega-3, USDA approved, organic. Who's verifying any of this? Hopefully, we trust the system. Do we trust the raters? It's the exact same problem with funds, and especially with ESG funds. So the way we try to figure out what is good ESG or what is bad ESG, at least in my research, we look at something called a database called a violation tracker database. And what is that? That database simply compiles the enforcement record for thousands of US companies across all the agencies that are supposed to take care of stakeholder interests. That's what ESG is about. So to make it a bit more concrete, if you're looking at labor, what is your track record with OSHA? If you're looking at the environment, what's your track record with the EPA, which is the Environmental Protection Agency? If you're looking at maybe antitrust, you look at the FTC. If you're looking at banking, you look at the record with the Fed. If you're looking at securities law, you look at the SEC. So there's a nonprofit in the US that has compiled all this for companies. So I can just go to Violation Tracker online, plug in, say, JP Morgan on Amazon, and you can see their entire rap sheet. And to me, that's one way to know. That's verifiable data. There is none of the subjectivity that rating agencies have. And if you're truly a good ESG stock, and if you're truly taking care of your constituents' interests, hopefully you have a very thin rap sheet as opposed to a long one with the regulators. So we need something like that, perhaps in every market. They've opened that in the UK now. Maybe we need an India violation tracker. And maybe that's the litmus test. Even that may not be a litmus test, because if you have had a bad history, perhaps you're on the mend and you're going to improve. But still, it's verifiable, it's objective, and that's arguably the big problem in ESG investing. Because finding something verifiable and objective is not easy. If we are buying a label, should we trust the label as consumers? Is organic organic? Is homegrown homegrown? Greenwashing is just one more extension of society's eternal fight in trying to police labels, because you need customer trust behind the label. Otherwise, the entire system breaks down to some extent. So it is good to have a law on the books. Of course, implementing that is always going to be a headache. The responsible companies will do more than what is required by legislation and regulation to truly use that maybe as a competitive advantage. I mean, I did some work for Unilever, where I think we found that if you have a green label, and if you can trust the green label, you can actually charge 5 to 7% more in terms of premium. So the only way any of this is going to work, and again, I'm a business school professor, profits are not a bad word in our school, values and value have to combine. Somebody has to pay more for this organic brand, for the green brand, and simply to protect the profits, companies will do the right thing, because it will hurt their brand. If it is just going to be a charitable exercise, charity is not sustainable. So maybe the only answer is integrate values and value, make it part of your brand, make it part of your strategy. A few, not everybody, but a few companies will try to distinguish themselves from the others. And the law is always going to be complicated. For example, we have global supply chains. If most of your product is made somewhere else, right, in China, how are you going to go verify that supply chain? Were they necessarily green? Did they not use child labor? Maybe they do, maybe they don't. So enforcement is going to be a big headache. It always has been. The only answer might be incentives. Get companies to take this seriously, because it affects their pocketbook. And to the extent you can combine values and value, this problem goes away. But not everything is an intersection of values and value. For example, you'll have so-called externalities. Companies do a bunch of things incidentally, like Coca-Cola, for instance, is the largest, perhaps unintended supplier of unrecycled plastic because of all the bottles and so on. Starbucks maybe generates, I'm forgetting the number, 7,000 or 8,000 unrecycled cups every hour. That's an externality. And the only way to solve an externality in economics is a tax. But again, that takes enforcement. So some part of this social problem has to be solved through taxation. Some of it maybe will get solved through branding incentives, but it's going to be a long, difficult problem.